Good afternoon, everyone. Thank you for being here. And today, my name is Mayank. I'll be presenting exactly why my PA is long Driven brand. So Driven is North America's largest automotive services provider with a highly franchised network of roughly 5,000 locations. I like to think about the business in three key segments: growing, legacy, and turnaround. So with growing, you have the Take 5 oil change asset, which is a drive-through style do-it-for-me oil change, looking at roughly 35% EBITDA margins on that one. With legacy, you have Pink Collision and Glass, which largely just fixes cars, and then you have Platform, which sells parts to franchisees, looking at roughly 50% EBITDA margins, really just a cash cow business that fuels Take 5. And then lastly, you have what the slide calls turnaround, but is actually, as of 48 hours ago, recently divested, which, as you'll see in thesis 2, is something we saw coming. So if you look at the industry that Driven operates in, you'll see that it's largely non-discretionary growing sectors. So if you look at the oil change business, you see a low single digits grower given the aging and expansion of the car park. People need their oil change, so the low single digits algorithm makes sense. Next, with Pink Collision and Glass, same logic. People need their cars to be operating and functionable to operate them. So you're also seeing a low mid-single digit growth rate there. And given Driven's over-indexation to a faster growing glass, we see conviction that they'll ride this tailwind. And lastly, car wash, which has become highly competitive in the last handful of years due to a recent private equity overbuild. But since management has sold this business, you see that almost 100% of EBITDA actually is in this non-discretionary growing sector. So zooming in on quick lube, which is quick oil change, the crown jewel, the main asset, the main story here. You'll see that when you're getting your oil change, there's really only two ways you do it, right? It's do it for me or do it yourself, with do it for me being the majority of these transactions. And within do it for me, you have quick lube, which is quick oil change, and other, consisting of dealership, general repair, and others. But quick lube here is gaining share from these players, largely because they're cheaper and quicker. And Take 5 is dominating the quick lube space. They're the fastest grower in this space compared to their peers, taking share actively from not only mom and pops, but also Jiffy Lube, which we'll get into later, as their perennial share donor. So largely what we're seeing here is that oil change and quick lube is going to be a high single digits industry growth algorithm that we think Take 5 uniquely takes advantage of. Which brings us to the story, which really starts in late 2023 when management cuts the guide for their car wash segment. Management really drove car wash as this huge part of the narrative, huge part of the business. So when this PE overbuild happened and they cut the guide, the stock went down almost 40%. But we see now that they've especially sold car wash that this has obscured Take 5's predictable 3-year earnings power, and these issues are gone how that car wash has been divested. So this is really an opportunity for us to own the best-in-class Take 5 franchise, easily and predictably taking share. It's a recession-resilient sector, secularly growing mid to high single digits, and whose largest player, as we'll get into, Jiffy Lube, is largely a perennial share donor. Which brings us to our three key bets here. First main thesis is really that the mature stores are going to continue performing. The second one is that the new stores will convert their EBITDA potential. And thirdly, that car wash isn't now a win-win, it's a confirmed win. And this brings us to roughly 13% delta on street on Take 5 EBITDA, 11% on the total firm, and our base case, which only underwrites earnings expansion in the business, not modeling for the car wash divestiture at all, still gives us a 29% IRR and a really attractive risk reward. So driving right into the first thesis is really just about the mature stores. The comps have lost sight about what quick lube is really about. It's about a quick oil change, right? What they're doing instead is pushing up ticket, adding all these ancillary products and services, which our primary research and channel checks confirm is turning these customers off and leading them to churn and go be customers of places where they can get service much faster, which is Take 5. We got a 5-year set of data that tracks mobile device location on how long these customers are spending at these locations, showing that Take 5 over the last 5 years has consistently been 20% faster than its peers for the last 5 years, right? And you think about why this matters. In quick lube, most of the customers are corporate customers. Corporate quick lube is the category. So here, these customers are coming on their lunch breaks. They don't really have time to waste at these locations, and 3/4 of them are repeat, showing that trust and loyalty win. So if you're getting your oil change and Jiffy Lube and Valvoline over here are selling you a $200 air ventilator when all you want is a 20-minute oil change, you're going to get pissed off, and you're going to go to where you can get service faster, which is Take 5, which we believe will drive volume capture. Where are they going to take this share from? Primarily Jiffy Lube. I've hinted at this, but now we're going to get into this. Jiffy Lube gets no attention from its parent company Shell, which suggests really bad underperformance. They're in a categorically terrible service. If you look at this Facebook group, they have a Facebook group dedicated just to their ripoff reports showing that customers really hate their service. Out of our survey respondents, 80% of our respondents wouldn't recommend them to peers, and the absolute cherry on top, when we called the locations ourselves, I was redirected to an HVAC salesman and a rebate scammer, showing us that this 60% share from Jiffy Lube and mom and pops is really ours for the taking. And this really starts to shine through in our alternative data findings. When we web scraped all 1,200 locations of Take 5 and compared them to peers in a 5-mile radius, they're almost, 34% more likely to be given a 4.5-star rating than its peers. And then if you look at Valvoline, which is its next closest player in terms of quality, Google search interest suggests that they're 20% more likely to be searched on Google. All of this really shows up at the top line, the volume capture. Our visitor traffic data set shows that Take 5 is driving 1.5% volume capture, while what does sell side and Consensus see? Consensus sees just another oil change company modeling 0% uplift and just sees it as just another player. Meanwhile, we have conviction on this roughly $30 million incremental EBITDA coming to mature stores by 2026. Bringing us to thesis 2. This is about new stores, and by new stores I want to clarify. I don't mean new stores as ones that haven't come out yet. By new stores I mean stores that have come out in the last 1 or 2 years that haven't matured yet. The key debate on the stock is that it's entering new geographies, the Northeast specifically. So Street and Consensus are highly skeptical of their ability to beat the incumbents. But the same alternative visitor traffic data that we have suggests that this actually isn't happening. To make this easier for you, the only graph that really matters on this slide is this one, which shows that they're not only tracking historical levels, they're beating historical levels in these new geographies. Now, how and why are they doing that? Well, to answer that question, what did we do? We took some field trips. We visited all the locations, all the new locations in Pennsylvania and New Jersey. And what did we see? The same thing I told you in thesis 1, that they're so much faster and have such much better service than its peers. As you can see, their cars per day are significantly better. They're taking share on speed and service. When we visited Jiffy Lube, not only did we witness substance abuse, they weren't even working on peak hours, 1. And then 2, when I asked the employee why or if they like working there, I'm not sure if I can say exactly what he told me, but largely he didn't like working there, which shows that this is a deep moat that Take 5 has created, and the comps can't really just copy them and be like Take 5. Take 5's new stores are winning in new geographies, and this is the key debate that we have conviction on. And the reason and where this boils down into is EBITDA. When we got our hands on the franchise disclosure documents, we see that as these stores mature, the royalty ramp goes from 1 to 3 to 5 to 7 as the stores mature. And while Consensus doesn't even agree that these stores are maturing, they don't model the 7% royalty ramp that we see, which gives us almost 30 million incremental EBITDA that the street doesn't catch on. Second part of this thesis is largely just our margin of safety here. We wanted to get extra conviction that they have a right to win in this sector, and we see that that's exactly the case. If you look at their franchise offering, their 4-wall EBITDA, 4-wall ROIC, and payback period is far better than all peers, which really gives us conviction that their new stores that have yet to launch now will happen because their right to win amongst franchisees is best in class. Another note we want to have here is the modeling conversion rate. So we took the management guidance and consensus number for the conversion rate and modeled roughly 170 new stores a year. But what does that imply about their conversion rate? It implies that it goes from 20% to 12% all the way to 2027, which is a pretty stark slowdown. But when we looked at government law records ourselves, we saw that roughly 30% of these franchisees have actually already sourced real estate and have already started developing, which shows that, even though we can't get variance on 2027, 2026 new store conversion, we see this as an embedded free call option that if they convert at historical rates, this new store pipeline that hasn't even happened yet will provide incremental EBITDA. And one more note here is this platform segment. Platform is how they sell parts to franchisees. Everyone just hard codes this insignificant sector, but we did the work here. We saw that it's highly indexed to Take 5. As Take 5 matures and as Take 5 expands, we should be able to scoop up some incremental EBITDA from them as well at almost 100% margin. So we have stark conviction here. When we talked to the analyst about what we saw with the franchise royalty ramps and the stores maturing, he looked surprised, pulled up his model, and guessed that the timing of new store ads was why our model and his model didn't tie and why we had actual variance here. So we really have conviction that this isn't something that Street is seeing and what drives roughly 60% of our upside. And lastly, on car wash, again, you don't need to think about the slide. Car wash isn't win-win, it's a win. And we've seen this coming for months. If you read between the lines in management's tonality, you see that their tone on car wash has shifted materially. They went from, car wash has significant white space, to, maybe there's assets that don't belong in driven brands. Ultimately, that they've been doing work behind the scenes to sell it, and as of 48 hours ago, they have sold the business, which we really think makes the picture so much clearer. Now investors and Street can focus on what really matters, which is the crown jewel Take 5 asset, and as this picture becomes more clear, we think it will drive incremental buyers and incremental upside, even though the stock is already up 20% on the divestiture of car wash. So highly conservative base case that only models earnings growth and no divestiture. model gave us a 65% upside, which we think is ridiculously conservative, especially because we drive no multiple expansion, even though this is trading at a high single-digit multiple, and Valvoline and Jiffy Lube are trading at mid-teens. We think multiple expansion is another embedded call option in this thesis. Additionally, our black swan bear case, which models unprecedented fall-offs in the business, only gets us 18% downside, versus our bull case, which does have divestiture, gets us to over 100, showing us that risk-reward is really asymmetric here. Main one risk we want to talk about is EV disruption. Look, Take 5's geographic expansion is 25% better than its peers. Their EV disruption risk is significantly lower than peers, and even if you take the worst outcome, that's only a 0.5 negative % CAGR. But even if you agree with all of that, there's going to be a hybrid era in between before EV really takes over. And your hybrid cars need just as many oil changes as the gas cars right now, so we really think this is an overstated risk. Lastly, two other risks we want to have here is that there's labor shortage risk and management turnover, but when we talk to the franchisees, it's pretty easy to train these employees, so labor shortage we don't think is a problem. And in terms of management turnover, we actually talked to buy-side investors, and they said that management's actually going to be sandbagging their guidance for this year and the next, because they really want to build up this credibility with buy-side and investors again, really showing us that management is committed to turning around this business. So catalyst pathway, the first one's already happened 48 hours ago. The second one is that they're going to re-segment their business to show Take 5 as its main segment and main asset, which we think brings on KPI disclosure, more investor attention, and really just more focus on this crown jewel. And lastly, the last catalyst we see here is that management will reaffirm its 2026 and beyond guidance, and we think all of this will drive incremental buyers. And yeah, I just want to say thank you for your time and happy to open it up for questions. Yes?
How does their leverage compare to their competitors?
Yeah.
And should we be worried about rollover risk?
Yeah. So the proceeds from this car wash were actually going to be used to pay off the leverage. There you go. They're going to delever by roughly 1.8 turns to 2.7. So if they use all the sales from the car wash proceeds to pay down the debt, which is going to happen after we read all the covenants, their proceeds have to go through paying off this debt. So now they're going to be just in line with their peers. And sorry, what was the second half of your question?
What's the term of their debt? How long of a runway do they have before they have to refinance?
Yeah. Let me see if I have it here. I don't believe I know that off the top of my head, but if I remember correctly, they have some maturities in 2030 and beyond, not anything super imminent, but according to the covenants on one of them, it has to be repaid if they have additional cash, which is what's going to happen with the cash they got from car wash. But yeah, not anything super different from comps.
That's a question, is overbuild risk on the quick lube business. The car wash business, everyone thought it was a good business until it wasn't.
Yeah.
They got overbuilt. Valvoline, I know, has been pitching a growth story.
Yes.
As well too. How do you underwrite the risk that quick lube becomes oversupplied over the next 2-3 years? Yeah,
so I think that's definitely a very good argument that a bear would definitely say. What I'll say about Take 5 before I address the Valvoline part is that Take 5, it's very indexed to the south and the west, so they're not in the northeast at all. So like the whole debate was like they're entering the northeast where they have virtually no exposure. Management's distracted, so their mature stores in their existing places will be bad, but thesis one proves that not to be true. And then second thesis about as they enter their new geographies, you can see that this is their first location in the Northeast at all, and they've already outperformed their peers. And look, people will need oil changes like in the Northeast and all these geographic regions. And as Take 5 is one of like the more younger ones, and they're rapidly expanding to get this geographical exposure, we think the right to win doesn't really expose them to overbuilding risk, especially given that maybe their guidance on new stores slowing down is intentful, that they don't want to overbuild, they want to be cautious here. So when you think about it, there needs to be oil changes in all parts of the US, and if Take 5 has the highest quality and the highest speed, that's where customers are going to go. And if they want to go reach that market now, they can. And then in terms of Valvoline, in terms of incremental stores, if you look at the franchise offering here and there's the interest on Google we're seeing from customers, the right to win really just falls into Take 5. So if Take 5 is this asset that you can scoop up at this valuation, when Valvoline already gets credit for their growth story versus Take 5 gets no credit for it, it's really just a really good opportunity to buy this cheap. I know you had a question before.
I was just going to ask you, assumably the car wash business was a much lower return business or
lower
return business?
Yeah.
So then my other question is if they're taking $800 million in the sale,
sure.
Your discussion just a second ago, they're lowering the debt on that.
Yeah. How
much does that change the return profile, like ROE, return on invested capital, that is? And then my other question is, like you said, it's longer dated maturities. Is growth going to be the return adder, or can you teach us like how do you have any trajectory to that? In other words, can you think about, depending on store counts, what their return profile could change to over time?
Yeah, so their ROIC right now is like high 20s, low 30s, which obviously what's been anchored down by car wash. Like I can talk to this slide about car wash.
You said the four wall, but I was thinking about corporate.
Oh, yeah. Yeah, no, the four wall ROIC is like 40+%. As a firm, they're looking at high 20s, low 30s, right? Yeah. So if you take out car wash, I see it gradually approaching 40% as the larger part of the business becomes franchised, larger part of the business becomes Take 5. And if you look at car wash, I can explain that in a little bit more detail. So car wash inflected negatively on same-store sales because of the PE overbuild. It recently inflected positive. So this slide was about like how it's improving, it's a better business, how it's going to get bought because it's an improving business. So if you take out car wash and you focus on franchisees as a percent of their total store base, franchisees in the last handful of years went from 40 to roughly 60, 70%. So as franchise becomes more of the story, as Take 5 becomes like the crown jewel of the story, I wouldn't be surprised if ROIC converges to 40. Maybe not 40 all the way, but high 30s, which is significantly better than what it is right now.
Have they ever talked about backing out of the non-franchise, like the wholly owned stores at all?
Backing out is in the ROIC of those?
I think it's like if you franchise everything, you sell. Is that a transaction they talk about as they restructure at all? They
haven't talked about shifting all of them to franchisees. I know they're pushing franchisees, and as franchisees becomes more of the story, I think that's like a catalyst. But they haven't talked about like 100% franchisees at all.
That's the best return, I assume.
Yeah, of course.
What percentage of the stores are franchisee versus wholly owned?
Yeah, 60-40 in terms of Take 5.
So 60% is franchise, 40%
Yeah.
wholly owned?
Yeah,
And-
it's wrong on the slide. It's the other way. It's 60% franchise, 40% owned.
Okay, and then the growth is all franchise, or are they growing both?
They're growing both, but franchisees is becoming more percent of the mix.
Okay, that's interesting. And how unit economics have to be so much better for them on franchise,
Yeah.
return and all that. Did they tell you how many locations they think they can get to nationally? Do you have anything on that?
Their pipeline right now is 70 more. They have 1,200 Take 5 locations right now, and then their pipeline is 700 more, and they want to convert all of them by 2027. Okay. So roughly 2,000.
Do you know how many Jiffy Lubes are in the U.S.
Ooh, the full number, no. I do know that they have more of a presence in the Northeast where Take 5 doesn't. So like the whole debate was like, are they going to go and beat these incumbents in where they already have a lot of exposure? So like our view is yes.
Okay, when you did your model, you've got growth. There's a percentage of it that's coming from same-store sales growth.
Yes.
And a percentage that's from new stores.
Yes.
Can you break that down for us?
Oh yeah. I have this returns bridge. So 7.2% of this of our IRR is coming from the embedded stores, like the existing embedded stores, right? Only like 4.5% is coming from the new store. And by new store, I mean the stores that have launched since 2022 and 2024. In terms of actual new stores that have yet to launch, virtually none of our upside is coming from like stores that have yet to launch, right? Like most of this return is coming from embedded stores, which are like embedded mature stores, which have matured since 2022, and then the new stores, which are 2022 to 2024. So virtually none of this is coming from new stores.
All right, so what you're saying is you've got mature stores growing the top line.
Yeah.
3.5%.
Yes.
And margin expansion on top of that? 7.2?
Yes. Yeah, because like everyone drives this 2% price, which is just like mix shift and pricing of oil. So yeah. Okay. And the margin's coming from this royalty ramp, which people don't miss. So then you just miss the whole EBITDA entirely. Because if you don't believe the stores are getting matured, you don't believe that they're converting this royalty ramp.
Okay.
So you have upside on the top line and the EBITDA.
All right, sorry, we're over on time now. Okay. Yeah.
Thank you, guys.